start the show, let's talk about the refiners in trade today. Singapore GRMs have hit a life high of $25 per barrel. How will this impact the Indian listed universe? Sonal joins us for more on that. Sonal.
Thanks a lot for that. It's a big positive with the Singapore GRMs hitting a new high at the $25 per barrel mark. Just to give you some perspective, so far in Q1, these GRMs have averaged at that $20 per barrel mark, which compares with around $8 per barrel that we saw in Q4. Higher demand for diesel and gas and something relating to cracks as well is leading to these higher GRMs this time around. It's a big positive for standalone refiners, MRPL, Chennai Petro, Reliance Industries. All of them tend to benefit from higher GRMs. Even the oil marketing companies tend to benefit from this because remember, they have been going through some losses in the marketing segment, so this offsets the big losses that these companies are seeing. Interestingly, Morgan Stanley has also come out with a report in Reliance Industries where they talk about how their energy segment is going to see blockbuster results, on track to deliver its best quarterly performance in last 2 decades. Specifically for refining margins, they are running almost 2 times above mid-cycle. Petrochemical margins, despite China lockdowns, are up quarter-on-quarter, and they also are expected to go higher, majorly because there is recent correction in naphtha margins, which is the raw material. Upstream profitability is at its best ever because of higher gas and crude oil prices. That's why they have an overweight rating on the stock with a target price of 3,253 rupees per share. So the strong refining scenario is something that is beneficial for all these stocks.
Okay, all right, Sonal, thank you very much for that. Dipan Mehta of Elixir Equities is now joining us for some stock conversation. Dipan, great to have you with us here on CNBC TV 18. Appreciate your time. You know, this entire cheaper oil from Russia, which of course is now a significant portion of our imports. It was very minuscule earlier, and that is replacing higher cost oil. And for a refinery like Reliance, which can sort of process all kinds of crude, this clearly means earnings tailwind. How would you kind of build in earnings upside and hence, I mean, kind of stock reaction from this? Would you kind of treat this as temporary, a one-off? What's your sense? Go on.
Good afternoon, Prashant, and thanks for having me on your show. I think that's the reason why we are seeing such a superb outperformance from Reliance Industries. It's all to do with the refining margins, which are going to be, as you just said, blockbuster, and with Singapore refining margins at all-time high and some benefit coming from processing of Russian crude as well. I think that Reliance could come out with a solid set of numbers for the June quarter, and that would help in terms of reducing the debt of the company and provide more funds to invest in some of the other newer businesses, the digital business and the retail business. So I think we are seeing Reliance perhaps firing on all cylinders at this point of time. COVID pandemic is over and done with, so retail should do well, and with the kind of consolidation already taken place in the telecom industry, we could expect ARPUs also to gradually move up. So I think there are no issues with Reliance Industries, but from an investor's perspective, the only real concern at this point of time is whether Reliance will turn into a holding company or how the management will unlock all the newer businesses which they have developed over the past 5-6 years or so. Because right now I'm buying into too many businesses when I buy into Reliance, and not all of them may be of interest to every shareholder. So I think the key metrics to track over here is the unlocking of the value in the subsidiary businesses Reliance Jio and Reliance Retail.
The Morgan Stanley note on Reliance Industries released today says Reliance's energy vertical is on track to deliver its best quarterly performance in more than 20 years. Refining margins are running almost 2x above mid-cycle. Petrochemical margins, despite Chinese lockdowns, are up quarter-on-quarter, and upstream profitability is at its best ever. That's the Morgan Stanley view on Reliance. Dipan, what about the rest of the refiners? Something like a Chennai Petro, MRPL, anything that you find attractive? Because most of these stocks have already run up in anticipation of good numbers.
Yeah, good afternoon, Reema. You're right. I mean, and they are cheap and attractive, maybe dividend yield as well. So definitely a trading play at this point of time. And, you could expect some amount of pre-result buying also taking place in these standalone refiners. But buying into these companies is more on the trading side, on the trading portfolio side. For long-term investing, I'd still like to go with the market leader, that being Reliance. And, one never knows when the cycle will turn and the sentiment in these standalone refiners starts to, deteriorate. So from even a safety point of view, from a long-term investment, I want to avoid these companies. and stick with Reliance. But yes, there is a trading play, and because these stocks are cheap and they show high profitability, you could expect higher dividends as well. So you could see a rally in these stocks, but I'm not sure everybody wants to participate in it.
Okay, Dipan, stay with us. Metals is another space, steel especially, which is starting to come back a little bit. And there are multiple reasons which are coming together. Coking coal prices, for example, have been falling, but that's just one. There are more. Nigel is joining us with more details on this one. Nigel.
That's right. Steel stocks have taken an absolute drubbing in the last few weeks. That's after that export duty was levied on steel. That's to the tune of close to around 15% odd. But why do we say that steel stocks are set for a bounce, and why could they relatively outperform? Well, here's why. As we just covered, that NMDC, well, they have cut prices by close to around 25% in the last 10 days. Now, iron ore is an input for steel makers, so non-integrated names, particularly like JSW Steel, well, they stand to gain. Not just that, globally, coking coal prices, well, they were hovering around $500 on a per ton basis. And that was a big worry for all steel makers. Remember, coking coal is not available here in India, so majority of it is imported. Now, coking coal costs have corrected from around $500 per ton all the way to around $420 per ton. So input costs going down, both iron ore as well as coking coal. Well, you'll say, but then steel prices as well will fall, in sympathy with what's going on with input costs. No, but that may not be the case as of now. Why is that? Because steel prices have corrected by around 5,500 rupees per ton. The recent number that we have is that steel price, HRC is priced at around 64 to around 65,000 rupees per ton. Remember, from its peak, it was at around 76,000 rupees per ton. But in the last 12-13 days odd, it's fallen by around 5,500 rupees odd. So, it's already partly fallen. The other factors, you always compare steel prices domestically with what's going on in China. And Chinese prices have risen by around $20 to around $25 per ton. That's post the reopening that's taken place. So now if you look at it, well, domestic prices are at, a bit of a discount, close to around 5 to around 6% discount in comparison to imported steel. So that's giving them reason not to cut prices further. So put all these factors together, well, that explains why steel stocks are doing a relative outperformance in today's trading session. Back to you guys.
Okay, Nigel, thanks very much for that. Explained nicely. And this is the big one. China reopening and coming back in a big way could be meaningful for global commodities. Steel, of course, is almost a direct kind of a play. Dipan, any thoughts on any of these names here?
Yeah, I think correction in raw material prices certainly will benefit steel companies in managing their margins, considering realizations are lower. But considering where these stocks are trading at this point of time and volumes also are flattening out, export opportunity is limited because of the export duty at this point of time, I'm not that optimistic on the steel sector. And with the way inflation is going and all the corrective action being taken, you could expect a downturn in the commodity cycle, and that would be detrimental for steel stocks. So I'd like to avoid steel stocks at this point of time. Rather than that, I prefer to buy steel consumers like auto ancillary, appliance companies. I think as they go about passing higher steel prices, their margins will start to come back. At the same time, steel prices also will correct. So maybe you could see a decent improvement in their top line and bottom line because of that. So more positive on the steel consumers rather than actual steel producing companies.
So in the steel consumers like auto and auto ancillaries, which are the stocks that you particularly like where the risk reward is still attractive?
Sure, I think that after many years of underperformance, auto ancillary are really showing very good signs of turnaround in terms of volumes, in terms of higher realizations as well. And prefer to go for the four-wheeler companies like say Maruti or M&M at this point of time. And within the two-wheelers, would like to avoid more stocks with the exception of Eicher Motors. And within the auto ancillary space, I think Minda Industries, Minda Corp are our top picks over there. As also Sona BLW, I think it's an interesting company, although expensive at this point of time, but very high exposure to the EV market, so least to be disrupted because of the EV play in the auto industry. And there are many choices as well within the auto ancillary space. Even Bharat Forge is a quite interesting investment opportunity. So that's where I think investors should focus their attention on. And you could expect a decent outperformance, very good returns from auto OEMs and auto ancillary over the next 6 to 12 months or so.
Okay, all right, Dipan, we'll take a very quick break here. We are going to be coming back, more questions coming your way. We also have Pankaj Tibrewal of Kotak Mahindra Asset Management Company, our Alpha Manager of the day. We are back with that conversation as well in a bit from now. The Nifty is up a grand total of 1.5 points, so 16,586. The Nifty absolutely flat. We are back with more.
Welcome back. It's flat in the indices, but buying is seen in many of these fertilizer names. Mangalore Chemical and Fertilizer is up 20%. Madras Fert, RCF, FACT, or FACT. These stocks are showing you gains of close to about 5%. And once again, as we've started worrying about rising COVID cases, you've seen your traditional unlock themes like the hotel stocks come under pressure and profit bookings. So EIH, Lemon Tree, Indian Hotels, all these stocks are down close to about 2 to 4%. So those are two pockets which stand out with big moves. Let's talk about Metropolis Health. That's also trading under pressure. Ekta is here to tell us what's leading the stock lower.
Thanks for that. Well, yes, Metropolis has been in focus on account of a buzz of a possible minority stake sale, and today there were reports by Ken indicating that Flipkart in fact is leading the race to buy stake in Metropolis. The reports indicate that Metropolis is looking to sell minority stake. The other names which were doing the round include the likes of Amazon, PE funds including KKR, TPG, Bearing, Blackstone, and remember Apollo Hospitals had also signed an NDA with Metropolis. Now we do understand, and Ken reports that Flipkart is likely to ask for a smaller stake, and PE funds whom they have been negotiating with are likely to eye a larger stake when it comes to a possible negotiation. Now remember that Flipkart has already entered the health tech space by buying around 75% in Sasta Sundar marketplace for around 372 odd crores. So this possible deal, if in case it does happen, will strengthen its space when it comes to an omni-channel play, something that we've seen, for example, PharmEasy too, in the past by acquiring Thyrocare. Now CNBC TV18 has not verified this report independently. A lot of the experts who look at this space have also said that the valuations have corrected significantly for these diagnostic companies. For example, Metropolis is down over 50% from its 52-week high. It's trading at around half the valuations that it was trading at in terms of a peak in the past 1 year. So yes, this might be a lucrative deal to look at given the kind of valuation correction as well, according to a lot of the experts.
That's Metropolis, but Thyrocare is also in focus. That one from the lows is bouncing quite a bit, and it is in a way our unusual stock move of the day. Ekta, tell us more what's happening with this one.
Yes, it's higher now. What is a sluggish market? But you got to put the move into context because it's only 7 to 8% away from its 52-week low. So it's still hovering at those levels. And remember, margins have been a concern for Thyrocare. In the previous quarter, margins came in at around 28.8%, which was sub 30%. There is rising competition that they're facing from existing players, from pharma companies such as Lupin, Mankind, digital health platforms with the likes of Tata, MG, as well as PharmEasy that we were, sorry, not PharmEasy, but the likes of Flipkart, which might in fact be looking to buy Metropolis now. Players with larger financial backing such as Reliance and Adani. SpiceJet is looking to probably enter into a different kind of marketplace model when it comes to diagnostics. So those are real competitive threats which is resulting in pricing power, pricing pressure, and the likes of Tata MG, for example, launched a 100 rupee test in Bangalore when they entered the market. So there is a lot of competition which is taking place at this point in time, and one can't take away from it. But for positives, when it comes to Thyrocare, it's probably the name which is backing them up, which is basically PharmEasy, which acquired Thyrocare. They are looking in terms of improving quality at this point in time. Also, non-COVID test parameters will be watched out for. Remember, non-COVID-19 revenue was up 12% in Q4 of FY22 on a Q-on-Q basis. Valuation-wise, there's also a significant correction in terms of Thyrocare valuations when compared to its own valuations a year ago, as well as when you compare it to other companies which such as the Metropolises of the world, as well as the Dr. Lals of the world.
Ekta, thank you very much for that. Dipan Mehta is still with us. Dipan, before we get chatting about these pharma names, wanted you to comment on this money control exclusive where Zomato is likely to sign off on acquiring Blinkit, which was formerly known as Grofers, the quick commerce startup, where Zomato I think already has a bit of a stake. And the street was worried, right, about Zomato's aggression, how much they will have to invest in quick commerce, and now this acquisition of Blinkit. The stock has already corrected close to 58% from its 52-week high. Your thoughts on Zomato and what this acquisition brings to the table?
I think this was in the offing for many months, and largely acquisition has been discounted. But what is noteworthy is that the last investor con call, the management did say that going forward now, as far as new acquisitions are concerned, there certainly are synergy benefits between Blinkit as well as Zomato, and they will try and grow that business as well. The way the market conditions are and what comparable blue chip companies with good track record are available at reasonable valuations, I think investors would rather focus over there than maybe a new age
Okay, I think
digital business still loss-making like Zomato and with no clear pathway to profitability. So I would say that Zomato would remain pinned down for maybe a few more months or so. Digital businesses are great stocks to buy in bull markets, but in bear markets, I think they are the ones which bear the brunt of investor selling.
Dipan, a bit of a problem with the line there, but we got the point. Thank you very much for joining us with that perspective. Appreciate you joining in here on CNBC as always. Pankaj Tibrewal is Senior Executive Vice President and Equity Fund Manager at Kotak Mahindra Asset Management Company. He's joining us right now to take some questions. Pankaj, always great to have you with us here. Thank you very much for your time. As a fund house, I mean, what is the stance, Pankaj? Are you using these dips in individual names to add on to positions, or as some of your peers in the industry have pointed out, maybe being a little more cautious, kind of holding on to cash for better levels? Go on.
Thanks, Prashant. Good afternoon. For a while, we have been cautious on the markets, and that's the stance we are holding in for the near term. We believe that the last 24 months, the market were for masses. The next 12 months, market will be for classes. And you could see significant divergence between sectors and stock performance. And I think bottom-up stock-specific approach would be the key to navigating these market and challenging times. We believe that there are challenges which could lead to continuation of near-term volatility, and we need to contend ourselves with volatility which we have seen for the last 4-5 months. On the earnings season which just got over, clearly we saw that the pace of earnings upgrade which we saw for the last 8 quarters prior to that was clearly missing. So there have been not major surprises on the downside, but our concerns remain on the first and the second quarter number, where the risk remains on the earnings on the margin side, and that will be fully reflected in the first and second quarter. Our expectation is somewhere in the second half, things to start stabilizing, and we should get more clarity on the geopolitical order. I think by that time, markets would start pricing in a decent amount of rate hikes by central banks, and there would be some evidence of quantitative tightening, which probably we will see once Fed starts in from this month. So I think in the near term, remain a little cautious on the overall market, and I think bottom up is the way to go about, and we should carefully navigate the market over the next 6 to 8 months.
Pankaj, afternoon. When you say cautious, have you raised the cash call? Are you holding more cash than ever before? And in terms of bottom-up stock picking, a falling market always gives investors a good entry point. Anything that you've added on in the last 2 months?
Yeah, hi Rima. On the cash side, we never take big cash calls, and our limit across different funds is about 7.5%. I think over a period of time, we have realized that portfolio construction plays a very important role. And I think in our markets, I think people have overrated stock picking and underrated portfolio construction. Our effort goes into looking at portfolio construction more, even if we are cautious on the market. As far as some of these sectors and we have been bullish on, I think private sector banks clearly look to be a sweet spot. And we believe that financials, especially the private sector banks,